What's up everybody, it's Devin here. Thanks for stopping into my channel. In this video today, I am going to answer a question that I get all of the time. And that is, how does an infinite banking policy differ from a regular life insurance policy? This is information that most people will not share with you, but I'm going to do it. And you're going to have questions most likely. So when you do, make sure to put them in the comment section. I will get back to all the questions. If you have not subscribed to my channel, do that. Hit the bell so you get notified when I put out all these videos. I would greatly appreciate it. Let's jump on into it so you guys can understand exactly how this works. Okay, so guys, there are two types of life insurance policies. Very important that we understand these. First, there is term insurance. Term insurance is just renting a death benefit. That's all it is. You're renting it for 10, 20, 30 years. Basically, you're paying in premiums every single month. If you pass away during that term, your family gets a death benefit. That's the only benefit to term insurance. It tends to be the cheapest up front, but it ends up being very expensive over time. Because think about it, I'm 40 years old. If I got a 20-year term policy, it's going to be pretty cheap because I'm only 40. But by the time I'm 60, to get that same exact coverage for another 20 years, it's going to be exponentially more expensive. So what happens is most people, they get a term policy, they're paying into it over and over every single year, every single month, and there's never a payout. Life insurance contracts that are term insurance only pay out less than 2% of the time. That means that people outlive the term. And if they outlive the term and then they go to renew it and it's just way too expensive for them to afford, guess what generally happens? They end up passing away a few years later, leaving their family with zero. That's not good. So I don't really think term insurance is that good. I don't think it should ever be used over permanent insurance. Permanent insurance is for your entire life. We are all guaranteed to pass away. It is gonna happen. We just don't know when. So hopefully it's way in the future, right? But we just don't know when that's gonna happen. That is an inevitable event. So if it is inevitable that you're going to pass away, it makes more sense to have insurance on your entire life. That's whole life insurance. There's IULs, indexed universal life. There's VULs, variable universal life. Those two should never be used for infinite banking. And I've got videos explaining why, but what should be used is permanent insurance that is whole life insurance, properly structured. So we're going to get into the difference between a just regular off-the-shelf whole life and an infinite banking policy right now. Let's go. All right, so with life insurance, when you have an agent that knows what the heck they're doing, most of them don't, but when you have one that knows what they're doing, they can structure a policy with what's called base premium. Base premium is like regular off-the-shelf whole life. And then they can put on what's called a PUA rider, paid up additions. So base premium is what most agents do because that's going to pay the most commission. So most agents, they're going to do regular whole life with 100% going towards the base. That gives them the most commissions. So obviously that's the way they're going to design the policy. It gives the highest death benefit. So it's not horrible, but it's better for your family. It's better for your family when you pass away because it's a really big death benefit. However, I would argue that your need for financing, your need for access to capital is greater throughout your life than your need for an eventual death benefit. And if you structure it properly, you actually have the best of both worlds. You can use the money now that you put into the life insurance policy, and it grows into a huge death benefit over time. So the longer you live, the bigger the payout to your family. So here's the difference. Infinite banking policies are structured with base being low. So we basically lower down the base, lower down our commissions, so that way you have access to more of your capital. So if you have a base that is, let's say $10,000 a year, that's how much you're putting in to a regular whole life, the insurance agent is going to make a ton of money, a ton of commission. However, what we would do is we would lower that base, lower your death benefit, and put it to where you have only 10% going to the base. 15, 25, 30, 35, 40. We lower down that amount to the base and then put the rest of it into the paid up additions rider. Why do we do that? See, the paid up additions, there's very, very little commissions involved with those. It's only about 2%. Opposed to with the base, some companies pay up to 90% of what you're putting into base. So remember what I said, $10,000 policy, if $10,000 is going towards base, which is what most agents are going to do, that agent's going to make up to $9,000 in first year commissions. That's what they're going to push. But an infinite banking policy, what we do for our clients is we're lowering down that base. We're lowering it, making less commission, and then having you overfund the policy with paid up additions. There's very little commissions. So what happens is instead of us getting a bunch of commissions, you're getting a bunch of cash value. Paid up additions is basically like fully paid up life insurance. So you get a little bit of death benefit added to your policy, but you get a whole bunch of cash value. So the really cool thing about that is that you can use that cash value immediately in the first 30 days to go become your own bank. And then here's the cool part. Every single year with the policies that we use, they are mutually owned companies. That means you're a part owner of the company. And when they're profitable, you're profitable. They give you a dividend. So that is very, very important to understand. I'll get into this right now. So what we do with a infinite banking policy is we lower down the base, lower down the initial death benefit, lower down our commissions, have you overfund it with paid up additions, which gets you a little bit of extra death benefit, but a whole bunch of cash value. And then every single year that the insurance company is profitable and you get a dividend, that dividend option is going to pay for more paid up additions. Super important because paid up additions, they are adding to your cash value. So you're getting more cash value every single year from your dividends. And because it gets you a little bit of extra death benefit, that means that you have an ever increasing cash value that you can use tax-free. It's growing tax-free, and you have an ever increasing death benefit. Guys, I have policies that started at 7.6 million. That's kind of my biggest one, I would say. 7.6 million. When I'm probably going to die, let's say 80, 90 years old, the death benefit is up over $50 million because as I keep putting in premiums, it's compounding and growing tax-free. The dividend that's paid out every year, it's not guaranteed, but the company that I have this policy with has paid a dividend every single year for 160 years. So it's not guaranteed, but it's pretty much a sure thing. That dividend is paying for more paid up additions, which gets me even more cash value and gets me even more death benefit. So that's why when I'm likely to pass away, my family's got a huge amount of death benefit paid to them tax-free, but I could use all the cash value while I'm alive. And that's how life insurance should be used. It is life insurance, not death insurance. So hopefully that lets you guys know kind of the differences between a regular whole life and an infinite banking policy. Regular whole life is 100% base. So what most agents want you to do, they want to make the most commission. Infinite banking lowers down that base, lowers down the commission, lowers down the death benefit, has you overfund it with the paid up additions rider, but that's getting you a whole bunch of cash value. Less commission to the agent, more cash available to you. Then every single year when you get a dividend, that dividend is buying more paid up additions. So you have an ever increasing tax-free cash value and an ever increasing death benefit that is paid to your family tax-free when you pass away, not if. So guys, I hope you got a ton of value from this video. If you have not subscribed to the channel, do it. Share the video with other people as well. Put your questions in the comment section. I'll make sure to get to all of them. This was a quick hitter, but make sure to smash that bell, the like, all the things that the algorithm loves. Until next time, guys, I love y'all. Peace.